Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets in the world of wealth management and how all of this impacts our decisions on the best courses of action for your investment strategy and financial goals. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined on the call by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson, is also on the call with us. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Remember, if you have a question, it is likely that other listeners may have the same question, so please feel free to engage us. Well, based on some excellent feedback from our listeners, we have changed the format of our weekly call. If you're a first-time listener and would like a little more information about our private client services, we have a separate webinar that will provide you with this information on our website adjacent to this weekly webinar. So let's get right to what is driving financial markets. So we have a number of themes that we've been following regularly through these weekly webinars, and the guiding principle for all of this is to expect the unexpected. There have been lots of surprises this year. Volatility spiked 2 weeks ago to levels not seen since 2008 as equity investors became unglued over the situation in China. Declining economic growth and currency devaluation followed by a sharp fall in equity prices heightened global investor uncertainty. Adding to the uncertainty is the debate over the state of the U.S. economy and the U.S. Federal Reserve's and the Bank of England's decisions as to when they will start raising interest rates. When investors become uncertain, they hit the sell button, and a wave of selling of riskier assets like equities drove prices to lows not seen since last year. As it stands, most equity markets are lower on the year. Well, since early this year, we had been suggesting that global equity markets were expensive. Now, this did not seem to impede stock markets as interest rates remained low, mergers and acquisitions hit the highest level since 2007, and share buybacks continued to push stock prices higher until the market ran out of momentum and market participants all ran for the exits pretty much at the same time. Since June, global equity markets have seen a decline in value of $14.7 trillion, according to Bloomberg. Now, we've been showing this chart for the last few months. We'd called for an eventual correction of between 12 and 20%. We really did not expect it to happen in such a short time frame, but the confluence of events created some significant selling. We saw initial support on the S&P 500 near 1865 and a subsequent bounce back to near the 2000 level. It still remains to be seen if we have actually seen the bottom of the move yet, but we were right on our call, and we have been making sure that our clients have benefited from this. I'll talk about this more when we talk about our models a little further along in the presentation. We had been showing this slide regularly on our calls, that on an enterprise value to earnings basis, stocks were expensive. They're still relatively expensive, but at this point, a lot less so. With revenue and earnings growth still expected to be negative in the third quarter, the forward 12-month earnings per share data has dropped to 15.3 from 16.8 at the beginning of May. The 5-year average is 14 and the 10-year average is 14.1. So we're getting closer to better values, but there's still some way to go to get back to the levels like we had in 2011, 2012. Well, as portfolio managers with a long-term perspective, we believe that markets are cyclical. Remember the lows of 2009 and the emotional concerns that went along with them. I remember having lots and lots of conversations with clients explaining that we are at or near cyclical lows. Now, we are well off the recent cyclical highs for equity markets. It's not exactly clear how far into the cyclical downturn we've moved, so we are watching closely as to how markets are behaving. It is not necessarily about the economy, but about the perception of what is to come next. That is where understanding behavioral finance enters the equation. It is the psychology of the markets. Interestingly, the best opportunities present when investors are most fearful, synonymous with spikes in volatility and lower equity prices. So part of our job is to understand investor behavior and use it to our clients' mutual advantage. Now we have to gauge what comes next. Better opportunities, or is this it? So let's look at some of our key indicators. Bond markets. We pointed out in early August that U.S. high-yield bonds had turned lower ahead of the S&P 500, and that traditionally this was a good leading indicator. Well, now high-yield bonds have stabilized and turned a little higher ahead of U.S. equity markets. Now, this is not yet conclusive, but it may mean that equity markets may stabilize. And that is what we like about the Canadian high-yield asset class in our client portfolios. Less volatility, good diversification, and excellent risk-adjusted returns, better than the S&P 500 and S&P TSX indices that have significantly higher volatility. Well, in the U.S. Or in government bonds, from August 25th to today, government bond market volatility has slowed. We can look at the front end of the U.S. curve, which says there is not an expected September rate increase, but more likely one in October or December. Longer term, 10-year yields are a little higher, near 2.2%. Now, the steeper yield curve suggests a slightly better economy going forward, but limited expectations. In Canada, the front end is now suggesting no Bank of Canada rate cut, and farther out the curve, yields have moved higher, suggesting some better economic expectations and still limited inflation. In the UK, there has not been much change, still expecting a rate rise, but the timing is uncertain. The positive yield curve means better economic expectations going forward. In Europe, German government bonds are also little changed from 2 weeks ago. Still negative yield out to 4 years, and a slightly positive longer-term curve point to a very gradually improving economy, but continued very low inflation. Well, as I mentioned earlier, high on the list of factors causing financial market uncertainty is the question of what decision the U.S. Federal Reserve might make when they meet next week on September 16th and 17th. According to Bloomberg, 30% of traders expect a 0.25% increase in the Fed funds rate, which means, conversely, that 70% don't expect a rate increase. The Fed has certainly prepared the market for an increase eventually. And the Fed is anxious to begin interest rate normalization. Rates have been at their lows for 7 years. The Fed believes that the U.S. economy will continue to improve in the second half, but has said that they will make their decisions based on economic data. So what is new on the economic data front? Well, in the U.S. last week, key employment data was the main focus for financial market participants. The headline, non-farm payroll data, was lighter than expected, while previous month's data were revised higher. However, the trend has been down over the last 8 months. The unemployment rate fell to 5.1%, the lowest level in 7.5 years. But the labor force participation rate remained at levels not seen since the late 1970s and early 1980s. A key component to the data is earnings growth, and while it improved slightly and was somewhat better than expected, the long-term trend remains pretty much stuck. This is something that the Federal Reserve is watching closely. Meanwhile, inflation is running well below the Fed's target. So, whatever the Fed decides, interest rates are expected to rise, but only very gradually into the end of this decade. So there really is no need for panic on this front, which also means that all of the short-term speculation is just noise, and we definitely need to move on. Well, as for other parts of the global economy, the euro area unemployment continues to fall, which is good. Consumer confidence was slightly better in August, but inflation remains well below target. So the European Central Bank's monetary policy remains accommodative, and unlike the Fed, they continue to lean toward more potential monetary stimulus if necessary, according to their latest meeting last Thursday. In the UK, Bank of England Governor Carney wants to raise rates, but when is still the wild card. They will meet and announce their rate decision on Thursday this week. In China, China's trade surplus increased, but that happened as imports fell more than exports. In August, exports dropped less than expected 5.5%, but imports slumped by 14.5%. So still continuing signals of economic slowdown in China. Closer to home, Canada did officially endure a recession in the first half of 2015 with 2 quarters of negative growth, but that is now ancient history. For the month of June, GDP actually grew by more than expected, 0.5%, which could and will point to a change in direction. With future growth estimates now being revised higher, it is expected that the Bank of Canada will leave the bank rate unchanged at tomorrow's meeting. Oil prices have stabilized near the $46 level, so not much to report on that front or on the commodities front, which certainly has been a very volatile component over the last month or so. And it remains for the foreseeable future with low economic growth, low earnings, low commodity prices, low inflation, and low interest rates that we are going to continue to be in a low return environment. And investors will need to get used to me saying this on a weekly basis, but also will need to continue to adjust their expectations to this reality. We need to stay focused on risk and not be driven to chase higher returns at the expense of adding risk to our clients' portfolios. So let's talk about our models, portfolio models. In our fixed income model, we have 3 concerns. The first is interest rate risk. That's the future direction of interest rates and how they will affect fixed income assets. And secondly, duration risk, where we need to assess which part of the yield curve will be most impacted and where we should be buying bonds. In Canada, we have early signs of economic strength, which means that the Bank of Canada is likely not anxious to cut rates further. That decision we'll see more of tomorrow. Canadian core inflation, which is running at a level of about 2.4%, leaves us reluctant to purchase bonds that yield in the vicinity of 1.5%, as is the case with the 10-year Government of Canada bond. Inflation at 2.4% gives you a real return after inflation that is negative. So we don't want any negative returns on a real basis. We bought bonds at better levels in May. So at this time, we have little desire to add to that position. Finally, we also have to be vigilant on the quality of bonds that we own, also known as credit risk. We have to ensure that the companies whose bonds we own are going to be able to make their interest payments and repay their principal. This, of course, is crucial, and we spend a lot of time these days on this factor, especially with our high yield holdings, where we do see some potential opportunities developing. I've talked about this every week for the last few, but preferred shares are another of our fixed income asset classes and have suffered on the back of lower interest rates. Many of the higher yielding issues have been matured and replaced by lower yielding issues. Fixed rate reset preferred share issues are replacing the once popular and higher yielding perpetual preferred shares. The lower return environment has impacted this asset class significantly, but there's still some higher yielding perpetual preferred shares still available, and prices and yields are starting to look quite attractive here. This is an asset class that is clearly underperformed. It is clearly one that should be bought as part of a rebalancing. We reduced our exposure to this asset class in April, and we're currently looking to add back to this asset class now that it appears that they have hit bottom and turned the corner. But we want to own perpetual preferred shares, not fixed rate resets. In our global equity model, volatility remains elevated, so we're watching closely to see if and when this will present some buying opportunities. This is the application of our disciplined approach. We can still afford to be patient. we need to see how these higher levels of volatility will play themselves out. Historically, higher levels of volatility point toward a potential change in trend. So we are continuing our assessment of markets and what opportunities will prevail. In the U.S., the long-term trend remains intact, but a short-term correction has begun. We are looking to add to this asset class, but it is a question of when this might resolve itself. Year to date, the S&P 500 is down about 6.5%. The TSX broke down through its long-term uptrend line from 2009, year to date down about 7.5% at this point. Japanese equities finally started to correct. However, the uptrend is still intact, year to date up about 2%. UK equities continue to move lower, year to date down a little over 7%. And Euro stocks are below their lows from the Greek crisis in June, but still only up about 1.5% on the year. And in Australia, more declines, year to date down 6%. Well, as for China and other emerging markets, China's Shanghai Composite is down 5% on the year, and emerging markets are down near 17% in U.S. dollar terms. Now, interestingly, the ETF we buy for our clients is actually changed. It's only down about 0.5% on the year. So by comparison, our HIROC Global Equity model is close to flat on the year. And as for our 60/40 portfolio, which is a combination of all three of our HIROC models, it's up approximately 1.5% year to date as of the close of business last Friday. Now, as for the Canadian growth equity model, Paul, anything that stands out that we want to point out to our clients?
Thanks, Scott. I would just characterize what's been going on in the past few weeks as extremely volatile, so we are exercising extreme caution, and quite frankly, I think over the past 2 weeks this has been more of a trader's market than an investor's market. So for instance, if you had orders in on August 24th when the market was getting absolutely hammered, you would have been in a position where you bought at the lows, and you could be buying and selling every day, because it seems like one day the stock market is up like today and the next day it's down. So very much a trader's market. So we've done very little in this part of the model. We've got a few strategic positions in place with some potential events that could happen, and we wait on those for now.
And I'll add, just for our clients' edification, we regularly monitor each of the different asset classes that we want to buy, that we haven't perhaps bought yet, or that we want to add to, or when we're doing rebalancings, which asset classes we're going to add to, and we will look at each of those asset classes individually to determine what price points we think make sense, and we adjust these price points according to how or what we see in the markets, both from a behavioral perspective and an economic perspective. And so when we talk about being patient, we're not just sitting there on our hands, but we are continually monitoring each of those asset classes and trying to determine what those buy points should or could be, and staying on top of that at all times. Okay, well, that is it for today's discussion. Certainly, if anyone who's listening on the call has a question, this is the time to ask now.
Scott, I have a question that was posed to me last weekend by a new client of ours, and she asked about emerging markets, which have been hit pretty hard, as one of the charts shows, and basically just what our thoughts are on that and where we might look to enter into more of a full weight position in emerging market stocks?
Well, I think as I was saying, we're monitoring these things. They've definitely gotten cheaper. They may get a little cheaper still. I think we want to make sure that the market has hit bottom before we start to put our toes in. And I think that's just an ongoing process that we'll continue to go through. So that is something that we'll keep our eyes and ears to the ground for.
Okay, thank you.
I will also add, and I did mention this briefly, but interestingly, because we have hedged or a hedged ETF hedged back to Canadian dollars, the impact of lower emerging markets has actually been mitigated significantly by the actual ETF we own. So that's something that comes into play in our client portfolios. Is we're always trying to find which ETF will provide the best risk-adjusted returns along the way, and certainly that's something that's been beneficial, even though our actual weight is underweight emerging markets. All right. So, well, no other questions from our listeners at the moment. So if anybody who's listening to the recorded version does have a question, and I have had a couple of questions over the last week, one which I wrote about in my blog, and that was on ETFs. So feel free to have a look at that. There was an article in the Globe and Mail about the volatility of ETFs and how the regulators are looking closely as a result of the moves on August 24th. So feel free to have a peek at my blog on my response to that. But if anybody does have questions, and we certainly love to get feedback on these webinars, so any feedback that you might have on what you like, what you might want us to add to these calls, please feel free to get in touch with us with our contact information that's on the screen. But that's it for another week. Thanks for taking the time to tune in. Have a great week. Have a wonderful weekend, and look forward to chatting with you next Tuesday. So this is Scott Tomlinson signing off.